Hello, Cashflow Ninjas. MC Laffer here. Are you interested in collapsing time in your financial plan and become financially and economically independent in the next 5 to 10 years? You can register for a free webinar to show you exactly how to do that at cashflowtactics.com/ninja. And now to Cashflow Ninja, episode 169 with Bob Murphy.
Welcome to the Cashflow Ninja, the podcast empowering and inspiring people to discover how to generate their own income and manage, grow, and protect their own wealth in the new economy. Now, here is your host, MC Laffer.
Hello, Cashflow Ninjas. MC Laffer here, and welcome to another episode of the Cashflow Ninja. I have a great show for you today, and in today's show, we're going to look at how to use the Austrian economic business cycle to weather financial storms. My guest today is Bob Murphy. Bob Murphy is a research assistant professor with the Free Market Institute at Texas Tech. He has a PhD in economics from New York University. And after teaching for 3 years at Hillsdale College, Bob left academia for the financial sector, where he worked on portfolio management and economic research at Laffer Associates. Bob now is the president of consulting by RPM and runs the popular economics blog Free Advice and Consulting by RPM.com. Bob has testified before Congress, and he has given numerous interviews on TV and radio. He is the author of hundreds of articles and several books on economic topics aimed at the layperson, including The Politically Incorrect Guide to Capitalism, How Privatized Banking Really Works, which he co-authored with Carlos Lara, and Lessons for the Young Economist. Bob is a research fellow at the Independent Institute and is the Senior Economist for the Institute for Energy Research, where he specializes in the economics of climate change. Bob publishes the Lara-Murphy Report with Carlos Lara and also co-hosts the Lara-Murphy Show, available on iTunes. Bob is on the board of the Nelson Nash Institute, which promotes the understanding of Austrian economics and the infinite banking concept. Just a reminder that you can register for our free webinar if you're interested in collapsing time in your financial plan and become financially and economically independent in the next 5 to 10 years. You can register for this free webinar to show you exactly how to do that at cashflowtactics.com/ninja. Please share your feedback and thoughts on today's interview. You can let me know your thoughts on Twitter by tweeting me at MC Laffer or by email at info@cashflowninja.com. And please remember to join our mailing list by signing up at cashflowninja.com or texting Cashflow Ninja to 44222. To ensure that you never miss one of our episodes, you can download our free interactive smartphone apps on the Apple and Google Play app stores. You can support the show by becoming a patron on Patreon for $10 a month. And when you do become a patron, you get access to our private Facebook page where previous guests connect with listeners, and you get to access a community of people that are on the same journey as you are, where you can network, share information and ideas, and possibly find a partner for your next business and deal. When you do become a patron, I will also send you a Cashflow Ninja t-shirt. You can become a patron at cashflowninja.com/support. My friend Dave Zook says you can be conventional or you can be wealthy, but you need to pick one. At The Real Asset Investor, Dave and his company create value for investors looking for higher yield returns from real estate ventures, domestically and internationally. To learn more about the exciting investment opportunities The Real Asset Investor offers, such as the syndication opportunity at Mahogany Bay Village in Belize, or investment opportunities in the multifamily space in the U.S., visit cashflowninja.com/real asset investor. Gelt Inc. is a multifamily syndicator which has acquired over 6,700 apartment units valued at over $1 billion through a private equity syndication model. Gelt provides its investors with significant cash-on-cash returns while maintaining and enhancing equity invested for the long term. You can reach out to Josh Satin at josh@geltinc.com to learn more. Have you read Rich Dad Poor Dad? Are you interested in real estate investing and don't know where to start and how to get the results you want? For valuable information to get you started, visit JoinOps Properties at joinopsproperties.com. If you want to create an income stream of 8% on your cash or money in your self-directed IRAs within 90 days in real estate without finding the property, fixing it up, finding a tenant, and all the other management headaches, you have to watch the private lending presentation at cashflowninja.com/private lending. The wealthiest investors on the planet know how to capture their wealth and leverage it to perpetually grow it. If you're interested in learning the premier strategies of the wealthiest individuals and families on the planet, you can access your free webinar at cashflowninja.com/be-the-bank. Bob, welcome to the show.
Thanks for having me. Glad to be here.
Can you please share a little bit about your background and your journey with my listeners?
Sure. So when I was in high school, I really got into libertarian political theory and what's called Austrian economics, a particular branch of economics. And I said, this is what I got to do for a career. I want to become a college professor and teach this stuff. So I went to Hillsdale College in undergrad, went to NYU, got my PhD in economics, and both of those programs, were heavily Austrian in terms of the type of economics. I taught at Hillsdale College for 3 years, and then I bounced around and ended up in the financial sector, moved to Nashville working for Arthur Laffer of Laffer Curve fame. And then I just became a consultant, and so I was in this weird mix of academia and the policy analysis world. Like I was working for some free market think tanks, doing white papers and things like that for them, but also in the financial sector. And that's just with that background. I met in Nashville Carlos Lara, who was a private businessman, a workout specialist in terms of businesses and financial distress. And he introduced me to Nelson Nash's book, Becoming Your Own Banker. So where I am now is I have a bunch of different hats. I'm at Free Market Institute at Texas Tech, just as an academic economist, but I also am on the board of what's called the Nelson Nash Institute. And so that, it's training. We train financial professionals and teach the general public about how to use dividend-paying whole life policies for like cash flow management purposes. And it all, all those things, even though they sound like they're disparate, they all related in terms of people, understanding the importance of the free market economy and just taking charge of your own financial well-being and sort of realizing the dangers that are out there.
Yeah, and you guys have truly integrated Austrian economics with privatized banking and the infinite banking, and we'll touch on that in just a second. Let's stay on Austrian economics for a little bit. Really fascinating is their business cycle theory, and I think this is something that we've touched a little bit on the show, but if you could really just share a little bit more about the Austrian economics school business cycle theory.
Yeah, sure thing. So the first thing for your listeners is the phrase Austrian economics. That's just because historically the founders of this school of thought were from Austria, just like, the Chicago school now is a particular school of thought that, it doesn't just pertain to a certain city, obviously, or school. So yeah, the major tenets of Austrian economics, it's very focused on the individual, just trying to explain individual choices and actions in that sense. And then they do have, I think, a particular relevance. There's lots of different things about the Austrian school and why I went towards it and why I gravitated towards it. But for right now, I think their most important contribution and why people need to know about this particular school of thought is their business cycle theory. So it was developed by Ludwig von Mises, elaborated on by his, I guess you call him, disciple Friedrich Hayek, who probably many of your listeners have heard of, won the Nobel Prize for this stuff. And in a nutshell, the Austrian theory says that if you want to understand these boom-bust cycles in the market economy, don't just look at the bust. That's kind of where like the Keynesian mainstream focuses on and just says, geez, how come people aren't spending enough and businesses are laying off workers? Let's figure out how can the government or the Fed get people to spend more. And in the Austrian view, that's a mistake. The real problem was during the boom period. That's when the seeds of the bust were sowed. And it's the cause ultimately is that interest rates are pushed below their correct, or you might say natural level. And that gives this false feeling of prosperity and this false stimulus, if you will. And businesses start longer projects than really there's adequate savings to finish. And so that's the problem, that in a market economy, prices have a job to do. They communicate information. And so if the banking sector pushes interest rates below what they really should be, you're not doing anybody any favors. That's just giving a false signal to the economy. And then the way that plays out in practice is this unsustainable boom that then crashes.
Which ties into a lot of what's going on currently. But before we get to that, and looking at what's ahead and where we are right now, let's take a step back to the last financial crisis, because there's a lot of misinformation out there, and a strong Keynesian contingent or heavy opinion that's heavily promoted and propagated across all mediums. Can you share a little bit more about the view from an Austrian view of what happened in the last financial crisis? What were some of the things that contributed to it? What were the things pushing this bubble wider and wider? And what were some of the factors that it eventually popped?
Sure. So some of to review the history, if you remember, in the late 1990s, there was what was called the dot-com bubble, right? So there were a lot of stock market was booming, in particular technology stocks, internet stocks. And then that started crashing and was exacerbated by the September 11th attacks. And so, the U.S. economy was in store for a bad recession in the early 2000s. And so what the Federal Reserve did, and at the time the chair was Alan Greenspan, is it did the standard Keynesian play of slashing interest rates, right? So I think the federal funds rate, for example, was at 6.5%, and they brought it down to 1% by June of 2003 and held it there for a year. And so what happened is this fueled a housing bubble, and there were lots of other contributing factors, but the Austrian view is that the Fed pumping in money and having interest rates being very low, and we're not putting words in their mouth. That's the Keynesian prescription. They're saying, yes, cut interest rates to goose spending. Right. And so the Austrian point is that, okay, but just trying to get people to spend more, and in this particular case, the spending went into the housing sector. You're not doing anybody any favors by just replacing the dot-com bubble with a housing bubble. And, the story fits pretty well. And by the way, this isn't just, ex post fitting the data. There are plenty of Austrians on record during the housing boom years saying this is going to blow up in our faces. This is not going to end well. This is unsustainable. To pat myself on the back, I've gotten plenty of things wrong. Don't get me wrong. But in, October of 2007, I had an article using Austrian business cycle theory saying this could be the worst recession in 25 years. Right, so that was 11 months before the financial crisis hit. All right, so this, Austrians were in real time warning about this. So the basic idea was the Fed pushed interest rates artificially low. That made mortgage rates come down. People went into housing this time, but that was unsustainable because those interest rates weren't correct. And then when the Fed got nervous and started raising rates, so in mid 2004, the Fed started hiking, and they tried to give a soft landing. And remember, Greenspan was called the maestro and stuff. People were amazed early on about, he managed to spawn a housing bubble, or boom, even, so the recession wasn't so bad. That's great. Good job, Alan Greenspan. And the Austrians were saying, no, this is gonna come back to bite us. And, the Austrians, I think, were clearly right in that score. So that's what we think the basic picture was. And then Bernanke just did the same playbook, but times 100 in the financial crisis of 2008 and going forward.
A Keynesian like Paul Krugman, for instance, was saying, they should blow up the housing bubble. We should stimulate the growth and have people spending again. One of these other wisdoms was also that economic growth would be spurred by an alien invasion. So there's a lot of things coming from him. Right. But there were a lot of folks on the Keynesian side that said this was a great idea at the time.
Yeah, and I mean, for your listeners who don't know about you're not putting words in this, but literally just go Google Paul Krugman housing bubble replace, I think, the NASDAQ bubble or dot-com bubble. And again, you're right. Early 2000s, Krugman literally, he was endorsing somebody else said it. I forget who it was, but some guy like a writer for a hedge fund or something came out and said that. But Krugman was clearly endorsing it, saying, yeah, what Greenspan needs to do right now is replace the .com or the tech bubble with a housing bubble. And then, of course, people were ridiculing him later, years later, saying, whoa, good call, Krugman. And he was trying to, distance himself from those remarks. And no, that's not what I meant. But, it's clear, and it's not just that he said it, but that clearly flows right out of the Keynesian mindset that, yeah, the reason that there's a recession is because people aren't spending enough. So how do you get people to spend? Cause another bubble. That, in their mind, that's what the issue is. And the Austrians are saying, no, our model of the economy is much more sophisticated. There's a structure of production. There's interlocking capital goods. There's various processes of different lengths. The stuff all has to mesh. And you don't fix a bad economy just by getting people to go spend more. Or like you said, again, people, if you think you're putting your words in my mouth, go Google, go to YouTube, say Krugman alien invasion, and you'll see that, yes, during the financial crisis and aftermath, it wasn't his first option. Krugman would have wanted the government to spend money building bridges and building schools and stuff. But he literally said if we could fool people into thinking there was an alien invasion when really there wasn't, and governments around the world built a bunch of weapons that we then didn't need, that would be better than nothing. Because, again, in the Keynesian mindset, that the problem is there's inadequate spending. And so to get governments to to loosen up and spend, even because of some bogus alien invasion threat, that's better than these crazy right-wing Republicans who are worried about balancing the budget right now.
Right. And I mean, it's just kind of insane where we're at right now. To tie in into the present, trillions of dollars over. I haven't even checked it because it just keeps going up. But so far in debt, no balanced budgets. But let's tie into the reaction to it was a bunch of bailouts, money printing, to get the economy back on track. Share a little bit more of what is leading up to right now and where we are right now, in the economy and global markets, and, what are the bubbles, that we're seeing out there right now?
Okay, sure. So, the problem was, as people know, the crisis when it hit in the fall of 2008, one way of describing it, or one aspect of it, was there were a bunch of investment banks and other financial institutions that were holding mortgage-backed securities, or they were holding like the credit default swaps issued on those things, and so just people tied to where when the housing market started collapsing, so you had people who had bought a house and they didn't have the income to make the mortgage payments, and they were just speculators. And that was fine when housing prices were rising, because then, if you couldn't stay in the house, then you just could sell it and you'd be fine, walk away, or even the bank could kick you out and then they would take it over and it'd be fine because, they would have more than enough collateral to pay off the note. But once housing prices started crashing, all of that, that business model went out, and then that's where the pain kicked in. And so these mortgage-backed securities, which were just like securities that had like 1,000 different pieces of mortgages in them, now all of a sudden those are in jeopardy, or the people who issue credit default swaps now, and they were getting collateral calls and so on. So that was the crisis. So one of the ways the Fed dealt with that is the Fed started buying up mortgage-backed securities, and they also started buying treasuries. And so, you can look at the Fed's balance sheet, during all those rounds of what was called QE, quantitative easing, and just chart the S&P 500 index against the Fed's balance sheet. And for a long stretch there, the connection between those two, it's eerie how those things moved hand in glove. So that was the sense in which I was all throughout those, the Obama years, basically saying, the boom in the stock market here is artificial. This is because the Fed's buying up assets, and that's not the way to prosperity. So now the problem is the Fed's wanting to tighten. They're trying to unwind to get out of this, but they sort of painted themselves into a corner. And so in the latest Lara-Murphy report, which is a publication that Carlos Lara and I put out, we were just talking about that. And we're not sure yet, but it looks like the strategy is regulators are going to try to put pressure and other inducements on financial institutions to take on more treasuries and more mortgage-backed securities, because that'll help them with their capital requirements and other regulatory requirements, because the Fed doesn't want to just dump that stuff. If the Fed needs to shrink its balance sheet, they don't want to just dump all these mortgage-backed securities and treasuries, because that will make interest rates spike and it'll cause a crash. And so it looks like what they're trying to do is figure out a way to kind of induce private financial institutions to take on all these bonds that really, I think, have been overvalued because of the Fed buying them. So I think the stock market's overvalued. I think the dollar's overvalued. I think treasuries are overvalued. Last thing I'll say, and I'll turn it back to you which way we want to take the conversation, but having said all that, I think Europe might actually be in worse shape than the U.S., so it wouldn't shock me if Europe crashes first, which perversely would make the dollar strengthen in the short term if everyone flees the treasuries. So I'm not saying the next 6 months treasuries are going to go down. I'm just saying long term, I think that, they're in an unsustainable thing. As you say, with all the debt that's been one last statistic, there were 4 years in a row under the Obama administration, and of course, Congress is the one that spends the money, but he was the president at the time, where the budget deficit was over $1 trillion. Okay, I mean, there's plenty of countries that don't have a GDP that high, and the U.S. government was borrowing $1 trillion or plus per year for 4 years in a row, just to give people an idea of how much profligacy there was. But because interest rates were so low, we didn't really feel it. It was like, getting 0% APR balance transfers on your credit card debt. You don't really feel it until, those offers end and all of a sudden the interest rate spikes.
You're listening to Bob Murphy on the Cashflow Ninja podcast. We will be right back after a word from our sponsor.
Are you having a hard time finding great investment properties? Unfortunately, the best deals are rarely found locally. Successful investing begins with the right properties in the right markets. Norada Real Estate provides everything you need to invest in the best deals across the United States. Our simple, proven system will help you create real wealth and passive monthly cash flow. Learn how to find the best deals by downloading your free copy of The Ultimate Guide to Passive Real Estate Investing at noradarealestate.com. That's NORADA realestate.com.
You're listening to Bob Murphy on the Cashflow Ninja podcast, and now back to our interview. Yeah, and you touched on Europe. Let's talk about the health of the banking sector, because I've been watching that for quite a while, and I'm just amazed that Deutsche Bank seems to still keep its head above water. And the Italian banks, I mean, there was a little bit of a lot of shenanigans going on there, quote unquote, secret bailouts in one shape or another. But what's your view overall just on the banking sector, the health of it? And more specifically, you mentioned Europe, some of those European banks.
Sure. So I haven't seen the figures, fairly recently, but yeah, I mean, there was a period where the Italian banks, like the percentage of their portfolio of loans that were non-performing, I mean, it was in the double digits. It was higher than what had happened in the U.S. during the height of the financial crisis. Because I don't remember the figure off the top of my head, but I mean, it was astonishing the situation they were in, and yeah, it looked like it was just that the ECB was through various means, doing things that were at least prima facie totally against their charter. Like the ECB wasn't supposed to be able to do that stuff, but they were kind of doing it anyway, just bailing out certain governments, and that was what was keeping the whole thing afloat. And then the Fed, in turn, had all kinds of dollar-euro swaps going on with the ECB to sort of keep the euro from blowing up too. So, I mean, these crises would come up, and then the central banks would, sort of clamp down on them, and then the crisis would pass. But it's not a stable fundamental situation, and I think we saw Greece and Cyprus and all these things hit, and then people kind of just move on with their lives and forget and say, "Oh, glad that's over with." And I don't think they've solved any of the underlying problems. I think they're literally papering over them in the sense of when a crisis comes up, the central bank just creates money out of thin air and tries to put the fire out. But I think eventually that they're going to stop being able to do that. That investors are going to say, okay, you can't just keep doing it. And I think that's what's happened with the U.S. So with Yellen coming in, I do think that was like a regime change. She oversaw the so-called taper, and actually the Fed's balance sheet has been flat since like the fall of 2014. And so I do think central bankers are trying to tell investors, okay, we're done printing money every time the stock market dips. Now we're serious about tightening, but again, it's a tricky situation they're in because they don't want to just sell the assets because that'll crash the financial sector.
Now, back to the U.S. In the U.S., we've seen a little bit of a Trump boom since he's gotten into the White House, and a lot was driven about the tax reform that was promised, infrastructure spend, healthcare reform, besides his other policies such as immigration. None of that has really come to fruition or has been enacted. Do you see this boom lasting? Does he get any of this done? What are some of your thoughts on that?
Yeah, so here, I mean, I'm just speculating. I think what happened was, when he first, so I think Americans were shocked that he went. I was certainly shocked. And, I think even a lot of Trump supporters didn't really think he was going to win. They just were saying, I can't stand Hillary Clinton. I'm going to vote for this guy. And then they were very pleasantly surprised at the outcome. I think that's kind of, but I mean, you could hear people like I was listening to NPR and these sort of mainstream news outlets, and they were like literally in shock election night. They could not believe he won. So, and I think you could see within futures markets that, U.S. markets it looked like they were going to crash the next day. And then all of a sudden they flipped and started booming. So my big picture is I think initially it was a shock. And then people were kind of like, well, he's talking about cutting taxes and stuff and trying to be Reagan. And maybe this guy actually, and deregulation, maybe, he's a businessman. So I think that's kind of what happened is that it went from, for a while, he was like this joke to all of a sudden he's the president. And then, but you're right on issue after issue. And there's various explanations for what happened, whether it's because he was bluffing the whole time or just, the opposition from entrenched interest, who knows? But yeah, he's not gotten stuff done. So I do think a lot of and the other element too is if equity prices had been, pricing in a Hillary Clinton presidency with all the kind of environmental EPA stuff she was going to do and tax hikes on the rich and blah, 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 just to say doing nothing for 4 years compared to what you thought was going to happen might make, an adjustment of profit expectations. But I think that's obviously all played out by now. So to answer your question, yeah, I think there was a short-term boost because people actually thought there might be some pro-growth reforms. But on issue after issue, people are more and more thinking that's not going to happen. And, now people are wondering, is he even going to be in office 6 months from now, with all these scandals and stuff. So my long-term negative view on like the U.S. stock market, for example, is still in place, especially because, it doesn't look like he's going to be able to get a lot of this stuff done, whether it's his own personal failings or because of, people opposed to him. Either way, it doesn't matter. If the issue is just, is there going to be huge tax reform? Right now, it doesn't look like.
Now, some of my listeners out there might think, okay, this has been a great discussion just around the business cycle and what really happened, where we are right now, some of the trends that we're seeing playing out. You and Carlos you guys put together a pretty excellent presentation on how to weather the coming financial storms, in which you discuss kind of a 3-step process and plan for people to protect themselves from this uncertain times that we're going into. Now, you discussed a little bit about building up a stockpile of currency, buying gold and silver and holding it physically, and also setting up an alternate warehouse for the remainder of your wealth. Can you touch just on those 3 points a little bit for my listeners out there?
Right. So the video is archived at Lara-Murphy.com. That's LARA-Murphy.com. You can see his notes out. But yes, and this was a thing we put out last fall, but I'm still, stand behind the stuff we said in it. So you're right. We explained, sort of like you and I have been talking about our pessimism about the overall health of the economy and why, people who have their money all in the stock market via 401ks or 403bs, like that might, not be the best place for your retirement funds. And, so our 3 things were, we're worried even about the health of the banking system. So we were saying, don't just trust I got FDIC backing up my checking account, that might not, come up, that might not be there for you. Right. So we were, the time frames differ from individual, but big picture, we were saying, that we thought people should have a month's worth of actual currency, like literal cash, in a vault in your house, just in case you can't access your checking accounts, if there's a banking panic. Depending on your preferences, let's say 6 months worth of actual precious metals in case, the dollar takes a big hit, that will help you weather that storm. But then for your cash flow, even so, you still need dollar flows. And so we thought opening up one of these dividend paying whole life policies structured the way Nelson Nash talks about in terms of what's called the infinite banking concept, that was the way for your needs in terms of things that are denominated in dollars, that was a much better warehouse for your wealth than some of these more traditional so-called safe havens that we actually don't think are that safe now.
Right, and we've discussed the Dodd-Frank Act on the show as well, talking about the safety of deposits in banks and how the banking system and the relationship of banking has changed. So definitely need an alternative place to warehouse your wealth in uncertain times. Now, Bob, one habit I've observed from wealthy and successful people is that they're always studying new subjects and learning new skill sets. What are you currently studying, and what new skill sets are you currently learning?
Well, I'm traveling a lot. I'm doing a lot of road trips lately, and so instead of just listening to music or whatever, I've realized, I should be loaded up on podcasts. So I've been trying to broaden my horizon, listening to Dan Carlin's Hardcore History. Just Jordan Peterson is on my radar now, and just reading his stuff. Was like he's just merging lots of different fields together, and I'm trying to also listen to I always, when I go online, I read perspectives of people who differ from me. I very rarely read people that I agree with 100% because I figure I already know where I'm coming from. So I just try to, expand my horizons that way. Those are the things but for me personally, I realize I have a gaping hole in terms of history. And so I've been trying to just, to fill in the gaps that way and to get more of a historical background, since a lot of this stuff, it seems new to us, but we realize these patterns are there beforehand, and so it's better to see, what happened before.
Absolutely. Now, core message in our show is to leave our families, communities, and the world better than we found it by passing down a mindset, values, and principles to future generations, not just money. So if you cannot pass on any money to future generations, and we're only allowed to pass on 3 principles to them to build wealth and achieve happiness and success, what would they be? Okay.
Well, one is, I'm personally a Christian. So of course, if I'm telling my son, what to do, I would, say, make sure you're following what God wants. And that's the most important thing. Another thing is just the importance of honesty. And I think people don't realize, how much we lie every day. We come up with justifications. Oh, well, I couldn't tell that person that. And I really think people just, even just being honest to yourself, will really help in that regard. And the last thing is just to not get overwhelmed by feeling, getting paralyzed of inaction by thinking there's too much stuff going on, and just to, real simple, but tell myself, come up with a list of things you're going to do today and do that, and not worry so much about, the big, just keep your head down and hit the things. What can I do right now about this? And not worry so much about problems that right now are beyond your influence.
Now, Bob, how can my listeners learn more about you, your podcast that you're doing? That's fantastic, and stay informed of all the projects that you're involved with.
Sure. As far as the stuff you and I have been talking about, the best website to go to is that Lara-Murphy.com. That's Lara-Murphy.com, where it has all information about the things we've talked about. And the podcast, in terms of just a fun exposition and discussion of economic issues of the day, my podcast with Tom Woods called Contra Krugman, where we take on weekly Paul Krugman's op-ed in the New York Times, Krugman being a big Keynesian. That's a pretty lighthearted, but also, I hope, informative podcast. So that's Contra Krugman, and Krugman's with a K. ContraKrugman.com is where people can find that.
Excellent. Bob, thank you so much for coming on the show and sharing your journey and knowledge with my listeners and providing so much value for them. It's been a blast connecting.
All right. Thanks for having me.
This is MC Laubscher, the host of the Cashflow Ninja podcast. As you may know, I'm also the president and chief wealth strategist of Valhalla Wealth Financial. We help individuals, families, small businesses, entrepreneurs, and professionals build their wealth outside of Wall Street and help investors maximize the use of every dollar in their personal economy and boost their investment gains. We do this by combining the capital and investments with the financial vehicle of the wealthy according to the infinite banking concept. If you're interested to learn more about privatized banking and the infinite banking concept, you can access an exclusive webinar at cashflowninja.com/be-the-bank. Thank you for joining my guest, Bob Murphy, and myself on the Cashflow Ninja today. We still have a couple of seats left. They're filling up really fast for our webinar where you can learn how to collapse time in your financial plan and become financially and economically independent in the next 5 to 10 years. You can register for the free webinar at cashflowtactics.com/ninja. If you like what you hear and appreciate what we're trying to build here at the Cashflow Ninja, please subscribe, rate, and review our show on iTunes and share our show with family, friends, in your network. I'm always trying to learn and improve in every area of my life, so if there's any way that I can provide more value for you and serve you better, please reach out to me at info@cashflowninja.com. If you're not a subscriber to the Cashflow Ninja Gashku newsletter, you can sign up for our newsletter at cashflowninja.com or text Cashflow Ninja to 44222. You can also support the show by becoming a patron on Patreon for $10 a month, and when you do become a patron, you get access to our private Facebook page and that awesome Cashflow Ninja t-shirt. You can become a patron at cashflowninja.com/support. Geld Inc. is a multifamily owner which has acquired over 6,700 apartment units valued at over $1 billion through a private equity syndication model. Banking on the renter revolution amongst millennials and baby boomers, all-time low home ownership rates, and a major shortage of well-located apartments at affordable price points, Geld has provided its investors with consistent cash-on-cash returns while maintaining and enhancing equity invested for the long term. For more information on how to achieve sustainable yield for the long term, you can email Josh Satin at josh@geldinc.com. Smart investors know that the banks actually don't own most automatic teller machines. In fact, the opportunity for private investment provides stellar passive returns, figures in the double digits, with the added bonus that most of the income is tax-free. Who wants to walk blindly past an ATM and not cash in on that opportunity? ATM machine ownership brings you a steady stream of hands-off passive income. Dave Zook and the Real Asset Investor team have been providing opportunities for investors in this uptrending activity of ATM use. If you're an accredited investor and would like more information on how you can invest in this exclusive asset class that very few investors will ever have access to, sign up for your free webinar on how to create income streams from ATMs at cashflowninja.com/real asset investor. Jimmy Freeland and Bob Scott have been in your shoes and have used real estate investing to become financially free. They have designed a system to take any beginner to an experienced deal-making investor in the least amount of time. They offer opportunities from basic education, coaching, bridge loan investing, to turnkey investments in the cash-flowing market of St. Louis, Missouri. For more information, please visit joinupsproperties.com or call Jimmy and Bob at 314-799-2247. If you want to create an income stream of 8% on your cash or money in your self-directed IRA within 90 days in real estate without finding the property, fixing it up, finding a tenant, and all the other management headaches that comes along with it, you have to watch the private lending presentation at cashflowninja.com/private lending. The wealthiest investors on the planet know how to capture their wealth and leverage it to perpetually grow it. If you're interested in learning in the premier strategies of the wealthiest individuals and families on the planet, you can access your free webinar at cashflowninja.com/be the bank. That's our show for today, everyone. Until next time, live a life of passion and purpose on your terms.
You have been listening to the Cashflow Ninja with your host, MC Laubscher, the podcast empowering and inspiring people to discover how to generate their own income and manage, grow, and protect their own wealth in the new economy. Today's show notes and resources are available on our website, cashflowninja.com. This presentation is for educational and informational purposes only. The information being presented and considered does not consider your particular financial objectives or situation, and it does not make personalized recommendations. This material is not intended to replace the advice of a qualified tax and legal advisor or other qualified professionals, and you should not use the information in place of a customized consultation with a licensed professional regarding your specific personal financial objective, situation, and needs. We believe the information provided is reliable, but we do not guarantee its accuracy, timeliness, or completeness.